In 2008, the world learned a terrifying paradox. The strongest financial system on Earth wasn't brought down by war, invasion, or foreign enemies. It collapsed under the weight of its own confidence. The same optimism that once fueled America's economic rise became the spark that nearly burned the global economy to the ground. It wasn't a bomb or a revolution that shook Wall Street. It was belief. Belief pushed too far, stretched too thin, and wrapped around mortgages that were never meant to exist. This is Hidden Finance File, where money, power, and truth collide. The fall of 2008 didn't start with panic. It began with celebration. The early 2000s felt like a gold rush disguised as real estate. Homes weren't just places to live. They were lottery tickets. Every year, prices climbed higher. Families who once struggled suddenly felt wealthy. Banks encouraged the fantasy, offering loans with interest rates too good to be true. And people accepted them because the dream of ownership was louder than the warning signs. Behind the scenes, a complex machine was humming. Mortgages were bundled, repackaged, sliced into pieces, and sold as safe investments. Wall Street gave them new names, new ratings, and new promises. But under that shiny wrapping lived rotten debt, loans given to people who could never repay, documents approved without verification, risk buried under layers of financial engineering so dense even experts couldn't see the danger. It was a time when trust felt infinite. Americans trusted the banks. The banks trusted the housing market. The housing market trusted endless growth. And Wall Street trusted itself, the most dangerous belief of all. But storms rarely announce themselves in daylight. They gather quietly, in shadows, in corners where no one is looking. And by 2006, the shadows began to thicken. Mortgage defaults, once almost unheard of, started rising. Slowly at first, like a whisper, then a little louder, and soon, the whisper became a pattern. Yet the system kept dancing. Investors still bought mortgage-backed securities. Rating agencies still stamped them with AAA confidence. And banks still lent money like nothing had changed. Because when an entire economy convinces itself that prices can only go up, truth becomes an inconvenience. Then the first cracks appeared. In 2007, two major hedge funds at Bear Stearns collapsed under the weight of subprime debt. It was like the first broken beam in a massive structure. Engineers don't panic when one beam cracks, unless they know the blueprint is flawed. Wall Street knew. But instead of sounding the alarm, many doubled down, hoping momentum would save them. It didn't. The housing market stalled. Home prices stopped rising. Borrowers who relied on adjustable rates suddenly faced payments they couldn't afford. Defaults surged. Foreclosures piled up. The American dream, once glowing with promise, began to flicker. And yet, in those early moments, most people still didn't see the fall coming. Because collapses are never obvious while they're happening. They appear slow until the moment they aren't. They feel manageable until the moment they explode. By mid-2008, the truth could no longer hide behind financial jargon. The machine had overheated. The gears were grinding. The system built on belief was running out of belief. But the real shock, the moment America realized the storm was unstoppable, was still ahead. And as the pressure built, as fear quietly replaced confidence, one question remained unspoken in boardrooms, trading floors, and kitchen tables across the country. If the strongest banks in the world were built on a fragile foundation, what happens when the ground finally gives way? The answer was coming, and it would change the global economy forever. And as the ground began to give way beneath Wall Street's confidence, the next tremor hit harder than anyone expected. Because once doubt enters a system built on belief, it spreads like fire, creeping through balance sheets, boardrooms, and entire nations before anyone can contain it. What came next was not a single collapse, but a chain reaction. Lehman Brothers, a 158-year-old titan, became the symbol of that unraveling. For decades, Lehman had survived wars, depressions, and political chaos. But what it couldn't survive was the very thing it helped create: Mortgage debt wrapped in layers of financial illusion. As default rates rose, Lehman's balance sheet started resembling a beautiful mansion supported by hollow beams. Elegant on the outside, empty on the inside. Investors sensed the weakness. They pulled their money. Trading partners backed away. Confidence, the oxygen of financial markets, thinned. And on September 15th, 2008, Lehman Brothers filed for bankruptcy. It wasn't just a company falling. It was a signal to the world. If Lehman could die, anything could. Markets plunged in real time. Trillions of dollars evaporated from global indexes. Entire retirement funds fell like dominoes. Banks stopped lending to each other, unsure who would collapse next. And in the middle of it all, ordinary families watched their home values plummet, their jobs disappear, their savings shrink. It felt like the floor beneath the global economy had cracked open. But the true danger wasn't just financial. It was psychological. For years, the world believed American finance was unbreakable. That belief held currencies together, kept global trade alive, and fueled the dreams of millions. When Lehman fell, that belief shattered. Suddenly everything felt possible, and not in a good way. Nations feared bank runs, corporations froze hiring, consumers stopped spending. Fear became the new currency. Inside the White House and the Federal Reserve, panic was no longer theoretical. It was immediate, existential. Officials understood a brutal truth. If one more major institution collapsed, the entire financial system could spiral into total paralysis. Credit markets, the bloodstream of the global economy, were freezing. Without credit, businesses couldn't operate, payrolls couldn't be met, and global trade would suffocate. So the government intervened. The Troubled Asset Relief Program, TARP, was created almost overnight. A $700 billion emergency package designed to rescue the same banks that helped cause the disaster. It was controversial, unpopular, and imperfect. But without it, the collapse could have been far worse. Still, the rescue did not erase the deeper question rising beneath the chaos. How did a nation with the world's most advanced financial system become vulnerable to its own creations? The answer lay in layers of risk hidden inside layers of trust. Mortgage-backed securities had been rated as safe as government bonds. Derivatives, especially credit default swaps, spread that risk throughout the global financial web. Insurers like AIG had quietly taken on obligations they could never possibly fulfill. It was a system where everyone assumed someone else was watching the fire until the flames reached their own doorstep. And while the public watched banks fall and stock markets convulse, another silent casualty was emerging: faith in the American dream. Families who had spent years building their lives suddenly faced foreclosure. People who had always played by the rules felt punished for the mistakes of institutions far beyond their control. Too big to fail became a bitter phrase, a reminder that power didn't land on everyone equally. Yet even in the darkest months, something else was forming behind the scenes, a realization. The 2008 collapse wasn't just an economic failure, it was a mirror, reflecting a system built on speed instead of stability, profit instead of prudence, complexity instead of clarity. And that mirror was about to reveal the final, uncomfortable truth of the crisis, a truth about what actually broke, and what it would take to rebuild. Because the fall of Wall Street was not just the fall of banks, it was the fall of certainty itself. And as the dust settled, the question that would define the next decade began to rise quietly. If the old financial world could collapse so easily, what would the new one look like? And as the illusion of certainty crumbled, a quieter question echoed beneath the rubble. If the system everyone trusted could fall with such force, then what was it really built on? The months after the crash exposed a truth far more unsettling than the collapse itself: that modern finance was not a fortress of numbers, but a fragile ecosystem of confidence, belief, and human behavior. When the panic finally slowed, regulators, economists, and ordinary citizens began looking back at the wreckage with a different kind of vision. It wasn't just the financial markets that had cracked. It was the very architecture of trust that held them together. The system had survived not because it was unbreakable, but because the people inside it refused to let it die. Banks merged. Governments injected capital. Central banks moved with unprecedented force. It looked like rescue from the outside, but from the inside, it was triage. Yet even stabilization came with a cost. For the first time in generations, millions began questioning the narrative that Wall Street always knew what it was doing, that markets were self-correcting, that prosperity was inevitable if one simply worked hard enough. The crash stripped away the story Americans had been told about their financial destiny, and what remained was unsettling. The recognition that progress is never guaranteed, and prosperity can vanish with the speed of a single trading day. But something else emerged too, a shift in power. While families struggled to rebuild their lives, the biggest banks became even bigger. Consolidation swept the financial world. Risk, once distributed through thousands of institutions, now rested in the hands of a few giants. The crisis that nearly destroyed them had also reshaped them, making them central pillars of a system even more dependent on their stability. It was a paradox born from panic. The institutions that triggered the collapse became the institutions the world could no longer afford to lose. And as the dust settled, a new financial era quietly formed. Central banks adopted near-zero interest rates. Quantitative easing flooded the economy with liquidity. Markets were propped up, stabilized, and eventually inflated to levels the pre-crisis world would have considered impossible. It was a strategy that saved the system, but also transformed it. Wealth concentrated further. Asset prices soared, while wages stagnated. Inequality deepened. And beneath that growing imbalance, a generational frustration began to simmer. For young people entering the workforce after the crash, the economy felt less like a ladder and more like a locked door. They hadn't caused the crisis, but they inherited its consequences. Student debt, rising rents, stagnant mobility. The promises of the old world no longer aligned with the reality of the new one. Trust in financial institutions, governments, and even capitalism itself fractured in ways the headlines never fully captured. And yet, change often begins quietly. The crash sparked conversations about regulation, transparency, and reform. Dodd-Frank reshaped parts of the banking sector. Stress tests became routine. Risk-taking grew more scrutinized. Some called it progress, others called it incomplete. But the most profound transformation wasn't written into law, it was written into culture. People began asking questions they had never asked before. How do financial markets really work? Who benefits when risk becomes profit? Why does the system reward complexity over clarity? And underneath it all, could it happen again? The answer, the uncomfortable one, is yes. Because the lesson of 2008 was not that a crisis is rare, it was that a crisis is inevitable when belief outpaces reality. Markets rise and fall in cycles not because numbers change, but because people do. Fear and greed follow each other like tides, reshaping the shorelines of the global economy again and again. But here lies the deeper truth, the one many missed even in hindsight. The crash was not just a warning, it was a revelation. It showed that systems built by humans can be rebuilt by humans. Stronger, smarter, more aware. It showed that transparency can replace illusion, that caution can balance ambition, that understanding can protect where ignorance once endangered. And perhaps most importantly, it reminded us that the story of money is never finished. It evolves with every choice, every policy, every belief we pour into it. The collapse of 2008 was a chapter, a painful one, but not the end. The world did not return to what it once was. It moved forward, altered forever by the realization that even the tallest towers can fall. Yet towers rise again, Not because they are indestructible, but because people choose to rebuild them. Differently this time, with eyes open, with minds sharper, with an understanding that resilience is not built on arrogance, but on awareness. And so the real legacy of 2008 is not the crash itself, but what it taught us about the fragile, powerful, unpredictable system we call the global economy, and about ourselves. That in the end, the most important asset any society has is not its banks or its markets, but its collective memory. Because memory is what prevents history from repeating, and forgetting is what guarantees that it will. If this journey opened your eyes to the hidden forces shaping our financial world, stay with us. Like, comment, and subscribe to Hidden Finance File, and continue exploring the stories most people never see, but everyone is affected by.